Ever wondered how day traders navigate the fast-paced, unpredictable world of intraday trading? Welcome to the thrilling arena of day trading, where financial fortunes are made and lost in the blink of an eye. Intraday trading, often called day trading, is a unique form of trading where you buy and sell assets within the same trading day. It's like a high-speed chess game, where quick strategic moves can lead to significant gains, or in some cases, losses. The objective? To capitalize on the day's price movements and close your position before the market shuts down. Now you might be wondering, how does this differ from other types of trading? Well, unlike swing traders who hold positions for days or weeks, or long-term investors who might hold assets for months or years, intraday traders are all about the here and now. They're in the market for quick, short-term profits, not long-term growth or dividends. But don't be fooled by the promise of quick profits. Intraday trading is not a get-rich-quick scheme. It's a craft that requires skill, discipline, and a solid strategy. Without these, you're just gambling, and the house always wins in the end. So, what does it take to be a successful intraday trader? Well, it starts with a robust intraday trading strategy. This strategy serves as your roadmap, guiding you on what assets to trade, when to enter and exit trades, and how to manage your risks. It's like your personal GPS, helping you navigate the choppy waters of the financial markets. But a strategy alone is not enough. You also need the right mindset. You need to be able to keep your cool when the market is in turmoil, stick to your strategy when things don't go as planned, and know when to cut your losses. It's a mental game as much as it is a financial one. Intraday trading can be rewarding, but it's not for everyone. It requires time, effort, and a willingness to learn. But if you're up for the challenge, it can open up a world of opportunities. Stay tuned to learn how to become a successful intraday trader. We're just getting started. Our journey into the world of intraday trading is about to get even more exciting. The first step to successful intraday trading is choosing the right assets. When it comes to intraday trading, not just any asset will do. You need to be selective, and one key factor to consider is volatility. Why? Because volatility, or the rate at which the price of an asset increases or decreases, provides opportunities to earn. Assets with high volatility are particularly appealing because their price movements can be more dramatic, and this can lead to greater profits. But the question is, how do you find these volatile assets? One tool that can be invaluable is the economic calendar. This handy resource can help you anticipate when prices might fluctuate, as it lists major events that could impact the financial markets. For instance, a central bank's decision on interest rates or a country's latest employment figures can cause significant price swings. By keeping an eye on the economic calendar, you can stay one step ahead and prepare for these potential trading opportunities. Now, once you've selected your asset, the next step is technical analysis. This involves studying past market data, primarily price and volume, to predict future price movements. It's about identifying patterns and trends and using this information to make informed trading decisions. For instance, if the price of an asset has been steadily increasing, you might decide to buy in anticipation of further rises. But technical analysis is just one piece of the puzzle. You also need to set your entry level, define your profit targets, and establish a stop loss. These elements are all part of your trading strategy, and they can help you manage your risks and maximize your profits. So, you see, choosing the right assets is not just about picking the ones with the highest volatility. It's about understanding the market, making use of tools like the economic calendar, and applying technical analysis to make educated predictions about price movements. Choosing the right assets is crucial, but what's next? Once you've chosen your assets, it's time to make your move. But how do you decide when to enter and exit the market? In the world of day trading, predefining your entry and exit points is crucial. Why is this so important? Because it helps to take the emotion out of your decision-making process. You see, trading can be a roller coaster of highs and lows. The thrill of a successful trade can quickly turn to panic if the market starts to shift against you. That's why it's so important to have a plan in place and stick to it. Imagine you're a surfer, waiting for the perfect wave. You wouldn't just jump on any old wave, would you? No, you'd wait for the right one, the one that's going to give you the ride you're looking for. It's the same with trading. You need to wait for the right conditions, the right moment to enter the market. And just as importantly, you need to know when to hop off that wave and exit the market before it crashes. The problem is, many traders let their emotions get the better of them. They second-guess their decisions, wondering if they've made the right call. They hesitate, they waver, and in doing so, they often miss the boat entirely. This is where predefining your entry and exit points can be a game changer. You see, when you have a clear plan in place, there's no room for doubt or hesitation. You know exactly what you're going to do and when you're going to do it. But how do you figure out these entry and exit points? Well, there are a few different strategies you can use, but one of the most common is to use support and resistance levels. These are price levels where the market has historically shown a strong reaction, either bouncing back, support, or falling back, resistance. However, remember that setting these points isn't about predicting the future. It's about managing risk. It's about making informed decisions based on historical data and current market conditions, and then sticking to your plan no matter what. So you've entered the market, but how do you protect yourself from potential losses? Well, that's where stop-loss orders come in, and that's what we'll be talking about in the next scene. So stay tuned. Intraday trading is full of uncertainties, but smart traders always have a plan B. Let's talk about stop-loss. Now, if you're not familiar with the concept, stop-loss is a predetermined level, a safety net if you will, where a trade will be closed automatically if the price moves against you. It's your shield against unexpected market movements, protecting your capital from significant losses. Why is it so important, you might ask? Well, imagine you're in a trade, and suddenly the market takes an unexpected downturn. Without a stop-loss, your losses could be substantial, potentially wiping out your trading account. But with a stop-loss in place, you've essentially put a limit on how much you're willing to lose on a particular trade. Now let's get into the nitty-gritty of setting a stop-loss. There isn't a one-size-fits-all approach here. Different traders use different methods depending on their trading strategy, risk tolerance, and the particular asset they're trading. One popular method is setting your stop-loss at a key level behind your entry point. This could be a significant high or low, or a major support or resistance level, depending on the direction of your trade. The idea here is to give the trade some room to breathe while still protecting yourself if the price reverses sharply. Another approach is using the risk-reward ratio. Let's say you're aiming for a profit of 50 pips on a trade. Using a risk-reward ratio of 1 to 2, you'd set your stop-loss at 25 pips below your entry point. This means you're risking 25 pips to potentially make 50, a trade-off many traders find acceptable. Remember, setting a stop-loss isn't just about limiting losses. It's also a way of managing your emotions, preventing you from holding on to losing trades in the hope that they'll turn around. It's a key part of disciplined strategic trading. But what if things are going well? When is the right time to take your profit? Knowing when to hold on and when to let go is a key skill in intraday trading. Let's discuss how to take profits intelligently. Now, we've all heard the old saying, greed is a trader's worst enemy, and this couldn't be more accurate. The market can change in the blink of an eye, and a few minutes can mean the difference between profit and loss. That's why it's so crucial to know when to take your profits and step away. Setting a predetermined target is an effective way to combat the urge to push for more. Once your target is reached, it's time to take your profits. But remember, the market isn't going anywhere. There will always be another opportunity to make a profit. Leverage is a powerful tool in intraday trading. It allows traders to control larger positions with a smaller amount of capital, which can significantly increase profits. However, it's important to remember that leverage is a double-edged sword. It can amplify your profits, but it can also magnify your losses. So, use it wisely. If you are confident that the price will continue to move in your favor, you have a couple of options. Firstly, you can divide your position and set several targets. This approach allows you to take profits while still leaving some of your position open to take advantage of any further price movement. Alternatively, you can adjust your stop-loss. By trailing your stop-loss as the price moves in your favor, you can lock in profits while still giving the trade room to run. In the end, the key to taking profits intelligently is discipline. It's about sticking to your plan, and resisting the temptation to chase after more. Remember, in intraday trading, the goal isn't to hit a home run every time, but rather to consistently hit singles and doubles. So you've made your profits for the day, but what's the final step? As the day ends, so should your trades. Let's talk about the importance of closing positions. In intraday trading, it's essential to remember that the dynamics of the market today might not be the same tomorrow. The financial markets are a complex system influenced by a myriad of factors, from geopolitical events to economic indicators and even rumors. Overnight, anything can happen that could significantly impact your trade. Imagine this: you've had a good trading day and your position is in profit, but then you decide to hold it overnight, hoping for a few extra points. You wake up the next morning to find out that the market has made a U-turn and your once profitable position is now deep in the red. How could this happen? Well, maybe there was an unexpected news release, or perhaps the market sentiment simply shifted. This is why it's crucial to close your positions at the end of each trading day. You see, when you hold an intraday trade overnight, you're essentially transforming it into a swing trade, which carries a different set of risks and requires a different strategy. Closing your positions also allows you to reflect on the day's trades, learn from your wins and losses, and plan for the next trading day. It gives you the opportunity to reset both mentally and strategically. However, it's not just about avoiding overnight risks. Closing your positions daily also means you can start each trading day with a clean slate. You're not tied down by yesterday's trades or preoccupied with managing open positions. Instead, you can focus all your energy on identifying new trading opportunities based on today's market conditions. So as the market winds down for the day, it's time for you to do the same. Review your trades, close your positions, and prepare to do it all over again tomorrow. Because that's what intraday trading is all about. Taking advantage of the opportunities presented by the market, one trading day at a time. By following these steps, you're on your way to becoming a successful intraday trader. Intraday trading might seem daunting, but with the right approach, it can be a lucrative venture. Let's recap on the key points we've discussed. First, choosing the right assets is crucial. You want to focus on assets with high volatility that provide more opportunities to earn. Second, setting your entry and exit prices beforehand and sticking to them, regardless of any second thoughts, will help you avoid impulsive decisions. Third, implementing a stop loss is a must. It helps you draw a line on how much loss you are ready to bear if the market swings the other way. Fourth, taking profits when the price hits your target helps you resist greed and secure your gains. Lastly, closing your positions at the end of each trading day eliminates any overnight risks. Remember, successful intraday trading is all about strategy, discipline, and continuous learning. Happy trading!